So, welcome everyone to the Emerging Markets Disclosure and the Audit Panel. For those who don't know me, my name is Shiva Rajgopal, and I've been tasked as the moderator, timekeeper, etc. in general. So, I just want to say a few things about the idea behind the panel, introduce our esteemed guests, say a little bit about the structure, and then I hope you will have questions for us. Okay, the questions are important, so start thinking about questions even as you listen to both Jim and Francine speak. So uh, I hope you've had a chance to listen to the other conversations throughout the day. I don't know whether Scott is here, but I think this is an incredible opportunity. So I've been saying this for a long time that a lot of academic research, essentially is done in echo chambers. We talk to ourselves as scholars, and we're very quickly losing both relevance to the outside world, either to practice or to policy, or sometimes relevance inside as well. So, we all live in our different silos. We worry about referees, others worry about something else. So Scott's made this opportunity possible to actually bring two phenomenal speakers to this panel. So I'm just going to talk about them. I'm sure if you're in the world of auditing, you've heard of Jim and Francine, but for those who haven't, let's start with Jim. So Jim Doty led the PCAOB as its chairman from February 2011 until January 2018, and he was the longest serving chair of the PCAOB to date. During his tenure, the PCAOB made the most extensive changes in the auditor's report in 75 years, established Audit Search as a data bank for identifying engagement partners, expanded cross-border inspection regimes, and brought enforcement actions against foreign firms, and established the Office of Economic and Risk Analysis. Jim also served as the General Counsel of the Securities and Exchange Commission from June 1990 to 1992. So Jim, I think, is a rock star regulator. And then we go to Francine. I'm a huge fan of Francine. If you haven't heard of Francine, if you're in auditing, please get to know her work. So Francine McKenna is an adjunct professor at American University in the MBA program, has taught special custom courses recently for the MAC programs, at Ohio State. She's an author of Accounting and Audit Research, and also an independent journalist whose newsletter, The Dig, covers accounting, audit, corporate governance issues at public and pre-IPO companies, including research that speaks to these issues. Francine is probably the best investigative journalist out there when it comes to auditing. So the way I was thinking of structuring the panel was to give each speaker 7 minutes at the beginning to what you may loosely call make their opening statements. I'll take 7 minutes after Jim and Francine have gone, and that's the order we intend to follow. We'll switch the order when it comes time for closing remarks. That leaves around 25 minutes for Q&A. So please send your questions through the chat room. Unfortunately, we can't let you speak. Otherwise, it's kind of pandemonium, sadly. But I'm looking forward to making this as interactive and useful for you as possible. And then we wrap up at the end around 6 o'clock or so. 6 Eastern. I'm going to have Francine and Jim come up with some closing statements. And in case you need to get in touch with us individually, you're free to do so in case your questions didn't get answered or you want to follow up on something. So when Scott was kind enough to find Francine and Jim for this panel, the charge I gave them was the following. Think about your long, distinguished careers and come up with difficult, intractable questions that PhD students can go after. PhD students in general have lots of time. The opportunity cost of your time in general is somewhat zero for a while, because you do have to graduate though. You have excellent training in methods, econometrics, psychology. But in my experience, at least my PhD students don't have good questions. So this is where Jim and Francine can really help. So they've got some great comments lined up for us. We'll start with Jim. The time limit is loose, Jim. Please take as much time as you want, because you rarely get an opportunity to listen to Jim and Francine at the same time. So over to you, Jim.
Thank you, Sheila. The scope and the depth of this University of Texas program is daunting for a former regulator. It leaves one wondering what a reformed lawyer and regulator can add that isn't really being better served in other panels. But I thought that in order to make the point that I think this is a very important generation of auditors and scholars that are coming into this area of academic investigation, that I would really try to hit 3 points. And picking up on things that you, Sheila, and Francine have said. First, why do audits add value? We have a reason for thinking they add value. Second, what do we need from auditors that the short sellers have? What do we need from auditors to reinforce that value? And then finally, what do we need from regulators? And I hope to make these 3 points and then open up into the discussion. But I think that first, with respect to the audit, it is a part of the success of the academic profession in audit is to have made us all more aware as investors and members of the public of the discretion, the accounting judgment that goes into the financial statement. But the financial statement is composed of estimates. It no longer has fixed, precise estimate quantification in it. That it is, in fact, a matter of judgment. And the judgment and the discretion in accounting is something which the auditors, of course, emphasize. But with that, I think, may go a greater thirst for a need for validation. The audit has value if it will validate and give some substance to what lies below these accounting estimates, the accounting judgments. If there can be data, if there can be testing of corporate systems, it may add some substance to disclosures that are perhaps going to become even more subjective. Compliance with ESG disclosure standards, non-GAAP metrics, key performance indicators, the evaluation of adequacy of dealing with cybersecurity risks. All of these are areas that are going to go into disclosure, apparently, and it doesn't seem to me that they're going to be convincing in terms of adding credibility to our financial markets if the auditors aren't looking at those and looking carefully and adding some real validation. So what do we need from auditors? Number two, I think my own experience as a regulator is that what we're missing, what we have missed often from auditors, is what I would call zeal. Zeal is different from just an auditor's decision that he's done enough under the firm manual to satisfy the firm's administration of an audit standard. It is instead of a determination to understand the business, the books, the transactions, get sufficient into the weeds, into the details, that there is real understanding of what the business involves. And zeal is that kind of commitment leads to an ability to change practice. Jamie Schmidt has written an article which I find encouraging and terrific, because it suggests, on the face of it, that the more auditors have discussed critical audit matters with clients, the more that has actually changed the disclosure, and in fact led the client to eschew some of the more aggressive earning management techniques. So to the extent that the auditor exhibits zeal, that the auditor really begins to understand the business and does not content herself or himself with just what satisfies the firm's standard, then they're in a position to change reality and to change it for the better. So in this, what do we need from regulators? Well, I think first we have to assume that the audit reporting, that the client-payer model is not going to change. In the absence of eliminating that conflict of interest by state action, which is replete with many problems, it seems to me that regulation really fills a very important part of this. And I think I've included 2 pieces of documentary material which I hope suggests some areas for students, one of which is the Kingdom report, so John Kingdom's report, and follow-up the Pavilion collapse in the United Kingdom. He suggests something that we need from regulators. The first thing he does is say some good things about what Congress did with Sarbanes-Oxley. He makes the point very forcefully, I think, that if you're going to have effective independent regulation of the audit function, you've got to have financial independence from the profession. Critically important. He goes on to talk about the staffing and the ability of the PCAOB staff, the inspectors, to create believers in the audit firm that they know what they're doing. You've got to have an adequate staff, and they've got to be motivated to exhibit some of the same zeal that I am discussing with respect to the auditors of the company's books. So I point to the Kingman report as a straw in the wind that you have movements afoot overseas that are going to change the audit world as we know it. There are different views among different regulators of the extent to which regulation should involve focus on disclosure, satisfaction of auditing standards, inspection of audits, as opposed to actually changing the business model. The Canadian regulator, for example, has the authority and does tell firms that they must divest of a client or clients, that they must abstain from and withdraw from representing certain industries or certain segments for a period of time. This is an authority that we would have to look at very carefully in the United States. Whether or not a regulator should be setting substantive standards that change the nature of the auditor's business model is a very serious question. On the other hand, you've got a model in here that very much goes in the direction of disclosure and enforcement for the failure to make disclosure or to follow the rules, the standards that are set out. And in this regard, I put in the correspondence with the President's Working Group on China, because I think one of the most important phenomena of regulation in the last 12 years has been the extension of cross-border audit regulation and oversight. And we will not get there without cross-border regulation and oversight. China, of course, is an outlier, and I think the materials that are there from the President's Working Group are useful. They are significant because they show how far the PCAOB has actually gone in moving in the direction of the inspection of audit files in China. And it is in fact important to keep moving that direction. I think China's recent search for or invitation for further discussion from Shenzhen, the letter of the Chinese regulator is attached to Bill Dunphy's letter. These indicate that in fact the Chinese have got this message. I think the Chinese know that being an outlier in the modern audit world is a bad thing. That to be an outlier without audit oversight and without the validation that goes with audits that are actually inspected by an independent regulator is a disadvantage in the capital markets. Christian Weitz, who's one of the inspirers of the PCAOB's economic analysis function, has written about this. Others have written about it. And I think that, again, is something we will need from regulators. We will need for them to keep pushing in this area. Other than that, I think that the research topics that are cropping up in this panel are going to keep you and your colleagues busy for a long time. And this is what regulators have needed. They have needed persons such as yourself that have a continuing serious economic interest in the audit and its relation to accounting disclosure and how to make the audit prove the accounting disclosure. With that, I will rest and listen.
Oh, thank you so much, Jim. Francine, you're on.
Thank you. And hopefully everybody can see my slides. Can I get a nod if you can see the slides?
I can.
Okay. All right. So I've invested professionally over the last 30 years, more than one way in the accounting and audit industry. So I'm a CPA with an accounting degree from Purdue. I worked at 2 of the big 4 KPMG Consulting, Bearing Point, and then PwC. And now I write and teach about the impact of regulation and legislation on the accounting industry and audit industry, as well as writing about corporate fraud and white collar crime and the intersection of these issues with the industry. So we often talk about the cost benefit of more or less accounting regulation and also more or less audit regulation. Well, it's my opinion that we're already there with less accounting regulation. So no matter what the FASB says, the market, and I learned this in particular the last 5 years as a full-time reporter at MarketWatch here in Washington, DC, that the markets focus on non-GAAP metrics. They don't focus on GAAP. Okay, they focus on the earnings reports, and nobody writes about the Q's and the K's, and only the most dedicated long-term value investors read the Q's and the K's. And almost everybody trades, which is an incredibly important part of the market and volume and pricing and everything else, trades on non-GAAP. Okay, so forget GAAP. And then if you start talking about audit regulation, the question is, you know, oh, well, you know, we can't live without an audit. Okay, the audit is a mandate, and we, you know, auditors are critically important. And of course, I would not have invested my professional life in various forms if I didn't believe that was true. Okay, I'm part of the profession and I believe that's true. However, we're already there in terms of a world without audit. Okay, and the Theranos case is kind of the example of a world without audit. If you're not familiar, this is the case of Elizabeth Holmes and Sunny Balwani, her COO, who developed a way to test blood, or at least that was what they said. They had a way to test blood from a drop, just one little drop. And now there's an HBO movie about it. There was a book by my colleague from Wall Street Journal, John Carreyrou, called Bad Blood. Okay, really good book. His reporting was excellent. And this talked about the fact that this private company, they never went public, it was a private company, had been promoting for years that they could accomplish this goal, develop this mechanism, this device to test only a drop of blood for many different things. And they were talking about enormous growth and revenue, et cetera, and it was almost all fake. And how did we find out about that? Well, there were whistleblowers that came to the Wall Street Journal eventually. And what was the essence of the SEC's actions against this firm? Well, they did an enforcement action and they talked about, you know, what kind of information was going to investors. Who were the investors? Some of the biggest names in the business, including Rupert Murdoch, who owns the Wall Street Journal and Barron's News Corp. You also had Larry Ellison from Oracle. You had the Walton family of Walmart fame. You had Carlos Slim of Telmex, one of the richest men in the world. You had people who otherwise in the rest of their life are CEOs or significant owners of public companies who know the role and responsibility of a public accounting firm and of an audit and why that mandate is in place and how they have to fulfill that mandate as stewards of public companies. However, when they invested their own personal funds in Theranos, they did not insist on an audit. There never was an audit of Theranos. There were never audited financial statements. None of the investors who invested nearly $1 billion in Theranos ever insisted on an audit. That tells me that there are already a significant number of sophisticated investors who do not see a value of an audit or may even think that it's an obstacle to investing in high growth pre-IPO companies or IPO companies, and they really don't want auditors and the regulation around audits to get in the way of that. So back in 2012, okay, I was primarily writing at a blog called Ray the Auditors, and that's blog is still out there, and it's pretty much just a repository of all of that archive and things I've written about since in other publications. But at the blog, I wrote that it was sexier for the media to focus on audit failures by the inscrutable Chinese Big Four audit firms than the general failure of auditors all over the world to protect the investors from fraud. So lots of people had proposed lots of solutions to solve the China problem, which is that China refused access to the PCAOB, to the audit regulator, to the work papers of China-based auditors, okay? Think about it. I wrote about this in 2012. The problem already existed. Jim worked on it for the whole 7-8 years that he was chairman. And we are still talking about it because the problem is really, really hard to solve. And it did not get solved. And in fact, I think the current regime in the SEC and PCAOB is going in the opposite direction. But this problem was, you know, already existed 8 years ago. So a few things have changed since 2012. There's a new SEC chair and a new PCAOB chair, but the song remains the same, okay? And now the approach is kind of a laissez-faire, caveat emptor. What are we gonna do? What can we do? And the idea is just give disclosure, tell everybody who the bad guys are or where the bad disclosure and bad information is, and let the investor decide for themselves. This is from a speech by Jay Clayton. You're going to have, in some markets, incomplete or misleading disclosures. What? In listed firms? Why? However, don't let that stand in the way of investing in these companies if you think they're super duper and that they might actually grow and you can trade on them and trade the volatility and trade the volume. This statement should not be viewed as an effort to restrict, to hold you back. Okay, so this is a very super libertarian, laissez-faire kind of, you know, disclosure is the superior regime. That's the role of the SEC. Tell people what's going on, tell them where the bad guys are, and that's enough. So that's where we are today. And there is a very strong constituency on the current SEC to take this approach, not only with regard to China and emerging markets and their inability to find a solution to this problem, but also with regard to things like Sarbanes-Oxley and 404B and other kinds of audit requirements. So where we had an enormous new reform approach from SOX because of Enron and Arthur Andersen, where we looked at building in stronger auditor independence prohibitions, all the prohibited services post-SOX, where we built in 404 internal control over financial reporting opinions, where we built in all kinds of other, there's a lot of other provisions of SOX, but you never hear about them, right? Clawbacks. If you delude the auditors, you can be criminally prosecuted. Have you ever heard of anybody being criminally prosecuted for deluding the auditors? No, it's a ready-made excuse, okay, for the auditors to avoid liability. And instead of going forward, and like maybe our compatriots in the UK are doing, Jim mentioned Carillion, the UK is going in the opposite direction. The UK is actually moving towards eliminating sort of the lock that the largest firms have on the audit market, looking at conflicts of interest and things like consulting, restricting them further from working in multiple things. Here in the US, we're going in the other direction with less regulation over audits. So one of the commissioners, Hester Peirce, is actually the very, the ultimate, you know, sort of caveat emptor, laissez-faire regulator, if you can call her that. She, in a recent case regarding Telegram, a cryptocurrency token situation, said, you know, why are we trying to restrain these folks from raising money and moving forward in an exciting, innovative thing. You know, they're not even in our, you know, they're not even in the US. They're not even raising money for mostly US investors. However, you know, should we really be restricting regulation just because 25% of the investors in Telegram were US and 75% were not? That's still 25% US investors. And I'll mention later, how did Telegram raise their money? Through Form D, which is a private placement mechanism that the SEC allows for private companies to use to raise money with no audit requirement or basically any scrutiny by the SEC whatsoever. So I tell my students at American University in the MBA program, I teach international business, not even accounting, right? That nowadays multinationals with US headquarters are only technically American companies. So companies like Apple, Caterpillar, GM, in many cases, the majority of their revenues come from outside the US. And yet the audit may be signed by a US audit firm and the listing may be on NASDAQ or NYSE. And a lot of non-US headquartered companies that operate in the US have significant operations in the US and sell their shares and bonds to US investors, such as Brazil's Petrobras, for example, and many banks as well, foreign banks as well, and foreign automotive companies may have significant audit work that's done by the US member firm of the Big Four in particular. Why? Because they have significant operations here, even if their opinion is signed by a foreign firm. The investors who are affected by quote unquote incomplete or misleading disclosures, as Jay Clayton mentioned about China, could be from anywhere. And the audits, despite the new Form AP disclosures of lead engagement partners and participating member firms, may be more complicated than they look, especially if the participating firms are not in the same network, okay? For example, I found out that on Wirecard, which is a German company that has been through a huge accusations of fraud and now is bankrupt, EY Germany signs the opinion, PwC Germany audits Wirecard Bank. And they have a significant operation in the US, and we're assuming, based on their disclosures, that EY US is the one that prepares the audit for that portion. So, as I said, Telegram, for example, raised $1.7 billion via SEC's Form D private placement process. And yet Hester Peirce is saying, why should we bother with restricting investors and investing in this? Most of the investors are not US investors. Okay, 25% of 1.7 billion is still a big amount of money that US people put in, but should we as the SEC and the leader in the free world, okay, in terms of financial markets, still, so far, should we abdicate our responsibility to all investors when we open the gate for them to raise the money in the first place on our market, on the SEC platform? So what kind of research would I love to see the new generation, the mid-career generation, the old generation, the people who are on their way out and have nothing to lose? What kind of research would I love to see you do? Research that finds novel ways to explore the impact of audit and disclosure quality for US listed firms based on US data, but that looks at the impact on capital markets when one spoke in a hub and spoke global audit firm network includes the US firm in a substantial role. Okay, so where one firm in the network is not operating up to standards, we should be paying attention if the US firm is playing a substantial role in that multinational's audit. Number two, research on emerging market audit and disclosure issues and how they affect US capital markets, or more broadly, global capital markets, but maybe with data from emerging market experience. So somebody in one of the previous presentations was asking, you know, if we are evaluating a regulation, let's say like auditor rotation here in the US, well, we don't have auditor rotation. And when we were trying to look at that proposal in the PCAOB, the big pushback was, Yeah, but there's no academic research to support the belief that by mandating auditor rotation in the US, it would improve audit quality. So therefore, we're stuck, right? But how can you have the research to talk about how it would affect the US market if we don't have that regulation? Well, it had occurred in other places, and there had been some research in other places where there was mandatory rotation. And the key is that in order to use that to make bold moves in terms of regulation in other markets, that research has to be really, really good. It has to be as broad as possible. It has to be bulletproof. It has to be applicable and transferable to other markets, even bigger ones and more complex markets. So I encourage, again, looking at the experience of other markets and these things that are innovative and new or that might work. And even if the target market for that regulation is not the one where we have any experience, we have to find really good ways of using the experience of other markets. There's a lot of opportunity for research that goes beyond the focus on audits in emerging markets and includes research on global networks that audit issuers with operations in emerging markets, and where the balance of work, accountability, regulation is based on this structure. So, you know, again, multinationals that have a lot of things going on and taking advantage of the new Form AP and participating firm data. There's a whole section of interest that I have that I don't think anybody's ever focused on, which is the role of Appendix K reviews. And that's a very specialized thing that relates to, again, a foreign issuer that is filing reports with the SEC because they're listed on a US exchange. There's a special role for the US firm who has to review all of those filings in order to make sure that they're acceptable from an SEC reporting basis. That particular role is sort of operates in the shadows. Sometimes it's a specialized unit in the audit firm. Sometimes it's a consulting arm of the firm that operates on a, you know, arm's length basis and gets paid for those hours of doing that work. But in the end, that particular piece often operates in the shadows. And for example, when we were looking at making the audit partner identification rules broader, not just the lead engagement partner, there was a lot of discussion about, well, should they also identify the quality assurance partner? Should
Francine,
they also
Francine, sorry. Should we? Would you be able to make the slides available to people?
Sure, absolutely. Let me just take 1 minute.
Okay.
We did some research. I did an article supporting watchdog research, which used audit analytics data. And we looked at issues around this cross-border relationship between audit firms. And we found some interesting results, okay? The key is that we as journalists, even if you're a research firm, can only go so far. We invite academics to go to the next step, to use more years, more data, more robust testing, and to go beyond what we can do with our limited means as journalists. And again, there's a couple other ideas here related to Form D and Appendix K, and there's a list of books that I recommend if you want to learn a lot more about how your research and these issues are translated into journalism and into media.
Thank you, Francine. It's Scott's fault. We should have had more than 1 hour. Okay, so let me try and say a few things here, building off of Francine and Jim's comments. And I hope to make this work. It'll eventually work. I just got a new computer, so can you see this? Anyone?
Yes.
Can you see my slides?
Okay.
Thank you. So I just want to acknowledge my co-author, Sri Ramamurthy, who I'm sure Jim and Francine have met before.
Yes.
For some valuable comments on what I'm about to say. So I'm processing what Francine and Jim told us from the lens of maybe an academic. Can I run a study? Can I run a study? That's what's kind of ticking away in my head as I speak, as I listen to them. And I've tried to identify a couple of big areas which they both touched on. This is not new, but I'm trying to think a little bit about, how can we actually go about doing this? So one of the things that I've worried about, and Francine mentioned this and Jim mentioned this as well, have audits become a license to operate in the US? Meaning, if you don't have an audit, you can't issue capital, you can't stay in business as a publicly listed firm, and sometimes even as a private firm, or do they add any value on their own? And this is a $1 million question, but it's incredibly hard to test. Partly because, there's no cross-sectional variation, which is just geek speak for the fact that, all public US firms need to buy an audit. So as Francine said, how am I going to find a firm that doesn't buy an audit? So you have to be creative. So people have done some work with the audits of private firms. Why would they buy audits and so on? You could look at emerging markets and foreign markets, which Francine mentioned. Some of our data sources are intriguing. I'd never heard of Appendix K, is it? Or time series, go back in time. So you could go and look around the SEC's Act or way back, perhaps even in different countries. In fact, I'm working on a project with a few people in the UK, where around the 1900s, I think big investors with skin in the game used to appoint auditors, which makes total sense, right? So look elsewhere is the short answer, and that comes with costs and benefits. People will immediately say that the result doesn't translate, as Francine said. This is what's the point of looking at Taiwanese data or Korean data? It doesn't really mean it means much for American firms. Yes, but that's the best one can do, unfortunately. So and this raises another issue. In the regulatory sphere, we don't run randomized control trials, unlike the folks in economic development, right? So using public US firms, there is no way to know whether regulation is useful or not, effective or not. So the best one can do probably is to go overseas or go back in time, is the summary. The other thing that's often intrigued me is the role of short sellers, right? I mean, the two latest examples, which both Jim and Francine mentioned, Wirecard and Luckin Coffee. If you look carefully, short sellers, they looked hard at the entire value chain. For example, in Luckin Coffee, they discovered that so when you walk in, you buy a coffee, they give you a token number or something. It turns out they were using those token numbers to measure number of customers walking into a store. And Luckin Coffee would skip every third or fourth token number. That's how they would inflate the number of customers walking in. And how do you discover this? Because short sellers actually sent in people to go measure this. Do you see auditors doing this? Not quite, So you have to wonder at a deeper level what might be going on. Do shorts simply have more incentives to look at the sustainability of the business model? For a while, I used to think maybe the true and fair model in the UK is a better model, and that's the model I've been trained in from India and in the Commonwealth. But that doesn't seem to help a whole lot either. We have a whole bunch of frauds in the UK as well. So how can one make auditors have more skin in the game somehow? I guess you could always argue there's litigation, and I've done some work on this. The number of lawsuits against auditors, at least 10b5 lawsuits in the last few years, has fallen to single digits. So when people ask in a classroom, where were the auditors? I say, oh, the litigation takes care of that problem. Well, not really, I mean, if you look hard, I'm not sure that's a viable answer anymore. The other issue, the independence issue, big problem, right? And there's some need to look at some other institutional arrangements which other societies have probably put in place. The UK ring fencing rule, which Jim mentioned, effective 2024, I'm sure that's going to result in a lot of interesting work. The split between consulting and auditing in the US post Sarbanes-Oxley, that's been looked at a lot. But as most of you know, consulting has come roaring back. Deloitte did not spin off its consulting unit ever. Should the stock exchange pick the auditor? Is there a regime out there where this happens? And how effective is that? That would be interesting to look into. I've already talked about the large shareholders idea from the 1900s. it's kind of intriguing. Should BlackRock pick auditors? They make a lot of noise about environmental footprint and so on. I would be happy if they actually use their clout to do something more substantive. Germany is a good case in point. In Germany, big banks have oversized influence in selecting auditors, and I'm sure that creates interesting conflicts of interest. So if you go look at Wirecard, I haven't done this, but I wouldn't be surprised if there's some bank connection. Because as you know, the distinction between equity and debt is a bit blurred in Germany. And a couple of other ideas which I'm sure have been floated around, but the way other regulators, even in the US, work with issues which actually impact people's safety. There's a lot to learn from the mining regulators, the chemical regulators. The NTSB, for instance, would put out a safety alert if there's a small problem in any airline, because obviously they don't want more crashes because human life is expensive. Why don't we see something similar with the audit world? There's so much secrecy. I've always found the audit industry kind of strange. It's an industry that pushes everybody else to be transparent, but they don't want to be transparent themselves. I've never seen a set of working papers. I'll talk about that in a minute. Stress tests that the Fed puts out, for the banks. I think they're flawed. I've looked at them fairly carefully, but at least there's something. And that it's disclosed, the parameters are out there. At least you have some sense for how these different banks would survive a big change in, say, some macroeconomic issue. Another institutional arrangements, if you're out there, if there is something that I've missed, I'm sure there is something that, joint audits, people have looked at that. The delegated audits idea, Francine mentioned, all these are interesting to look at. Now, the big issue, at least as an empiricist, and I'm not going to address this as an experimental person because I don't run experiments. This is a huge issue for me. Output variables are very hard to measure. Even if I find the perfect setting, what do I do with it? What am I looking for in terms of output? People have looked at things like cost of capital. I don't believe a whole lot of those cost of capital results. When I talk to the CFOs, they say we think about share price. No, we can't distinguish cash flows from cost of capital. That's kind of hard to measure. I'd personally caution people to not look at cost of capital type measures. So what else can I look at? Well, most of the measures that are out there are effectively earnings quality measures. Restatements, accruals. I often tell people, if you talk to people on the street, nobody believes these earnings quality measures. They don't even measure earnings quality well, let alone audit quality. So, we desperately need something to look at in terms of trying to figure out, was this a good or a bad audit? Of course, you can look for failure at the end. That's a possibility, perhaps. But work papers would be fantastic. And I've often joked that even the Official Secrets Act declassifies most secrets in 10 years, but we've never seen a set of audit work papers, except probably for Enron. And I came across this interesting story. EY actually paid $335 million in 1999 to keep their work papers secret in the Sendent case. So that tells me that the barriers to making this happen are very high. So as audit scholars, I think we are sadly, I hate to end on a down note, perhaps doomed to keep muddling through these earnings quality and cost of capital type measures. Can we ever conduct a thorough postmortem of audit failures? I don't know. So maybe this is a good time to stop, see if people have reactions, and then jump to questions. Thank you. Jim, yes.
A couple of hit points. First, I think we're all worried about a kind of inverse Gresham's law setting in here, in which people run to the audit firms that are more slipshod. This is something that is being thought about. We need an answer to it. One of the thoughts that has hit the deck from time to time is, why not just revoke the registration of some of these Chinese audit firms? Well, the problem is the registration with the board is the jurisdictional hook of which you can get the audit papers. So far, the audit work papers have been obtained only in the course of an inspection or an enforcement demand under an enforcement degree. That is something that could be looked at. Skin in the game. This goes to these business model examples I was pointing to. CPAB will tell a firm, given your performance in our last inspection of your look at a data processing firm, you should shed those clients until you have beefed up in that area. So there are different types of proposals that push you more toward a merit regulation of an attention to the business model. But you can create skin in the game if you can tell a firm you can't take more of these clients, or you've got to get rid of the ones you have. Different pay mechanisms. A lot of thought has gone into this. It would lead to a larger public company accounting oversight board with mechanisms it does not now have to gauge whether or not the fee has been properly determined after realistic view of the scope of the audit, or whether it's a discount just to get the business. And then your idea about postmortems. Perhaps a statute of limitations that somehow goes, or a statute of inverse limitations that somehow goes to public domain access after there has been an audit failure would seem not to be such a hard thing to do. Most of the PCAOB's inspection reports, of course, are backward looking. And I quite agree, we're going to have more with non-GAAP metrics. We're going to have more demand for forward thinking, forward looking attestation. Not to slow it down, but these are just response points to what's been thrown.
Yeah, let me just talk a little bit about the deregistering, delisting issue, because this is the legislative proposal. First of all, the legislative proposals are really short-sighted. They don't really include the whole population of firms and public companies that are affected. They're not looking at sort of the issue of, for example, a Chinese firm like Yum Brands that's headquartered in Texas, but has a Chinese audit firm, okay? I mean, what do you do about that? That's not covered under the legislation. And so what the research that Watchdog Research did, and the story that he wrote, sees is that the data is actually that firms that want to raise money out of China are saying, woohoo, okay, nobody's going to come look for our work papers. And frankly, you know, maybe we just don't even want to deal with this. And so there's been a trend since 2017. They don't even need to be listed on a US exchange and deal with that potential uncertainty of when and if something might change. They're just going to list on Beijing and Hong Kong. And that's what's happening. More companies that out of China are saying, forget it, we're not going to list, or they're saying, forget it, we don't need a US audit firm for any part of it. We're going to have an audit firm based in China because we know no one can come and get us. And that's really the situation. That is the trend. They know that others have thrown up their hands, and yet traders, investors are still buying their stock. Luckin had EY China as the auditor, okay? It does not have any operations in the US, okay? And yet it had significant institutional investors and gatekeepers from the US that were helping them raise money, and lots of US investors when there was absolutely no touch point to the US except for NASDAQ.
But Francine,
Okay.
here the fiduciary principle gets to be important. In other words, are boards going to be sued, shamed into, or forced by private process into getting audits or into changing auditors? That is a long bet. But when firms continue to buy, or investment managers continue to buy Chinese stocks with all of this going on, that the fiduciary principle moves a little closer to accountability.
Right.
I mean, that's one way of looking at it. The whole approach, I think, to China now is going to be through legislation. It will be interesting to me to see whether this proposal of the president's working group gives the Chinese the out of taking the co-auditor. If you take the co-auditor route, then they're complying. If you
I don't think they're going to do it.
We would both have comments on what co-audit danger is.
I think they're going to do what Alibaba is doing, which is Ant Financial, which is a huge financial arm of Alibaba that's going to spin off. They said, forget it. We're going to list in China, in Shanghai and Hong Kong. Okay, Alibaba is the poster child. Jay Clayton was involved in helping that go public, and it's listed on a U.S. exchange, and it has PwC China as the auditor. all this time, and yet nobody blinks. And so if you said, oh, they can't be listed on the New York Stock Exchange anymore because they're audited by PwC China, they've already anticipated that possibility, and they've said, so what? Investors are still buying Alibaba, and they're going to buy Ant Financial, even though
you're right, Francine, to point to that pragmatic. I would just point out one thing as we sit here. The only clear violation that the United States authorities have in the case of Chinese issuers is the failure to obtain an audit with a firm that permits inspections by the PCAOB. In other words, that's the hook right now. And it will be interesting to me to see whether the legislation goes forward. I think what Kennedy and Von Hollen have seen is that if you're going to get the Chinese to move, only if it's the draconian result of excluding them from the U.S. market. Now, that is a real threat. That's a real threat.
So if I may chime in here, a couple of points, just to add to what Jim and Francine said. I think what hasn't come out in the discussion so far is the role of the index makers, the MSCIs of the world. So who are these investors? It's you and me buying through our 401ks and 403bs, ETFs, which have some emerging market or Chinese component. So if you ask me, I think the buck stops there. You know, I think Francine mentioned that people rarely look at the Ks and the Qs. It's such bad news for us folks who do fundamental analysis research. Maybe it's good news because people ignore fundamentals and there must be money to be made. But why? Because we've delegated that fund research to the index providers.
There's an example of that. The most recent head of investment policy for CalPERS, the California State Pension Plan, was someone who was born in the US, but grew up in China, was educated in China, and then came back to the US. And CalPERS is significantly invested in Chinese companies, significantly invested in Chinese companies. The California State Pension, okay? How many of those companies that CalPERS is invested in have a Chinese audit firm that has never been inspected? Okay, this is the vulnerability, and this is the sort of what's developed over time. Because we hoped, we prayed, we negotiated, Jim and others did the best they could to try to bring China to the table. And in the last 3 years, this administration has thrown up their hands and said, caveat emptor, okay? As long as they disclose that we can't go after them and that they may be misleading or manipulative, that's enough. And if investors still want to invest, we have to let them invest. I think that's wrong.
You know, the risk to them is shaming. If U.S. firms do a co-audit under what I'll call the Mnuchin proposal here, and it turns out to be bogus, if in fact we continue to find problems in, as you said, Francine, audits in which the U.S. firm signs off with most of the work being done abroad, the fact that these are affiliates of the corporate, of the franchise, the firm franchise is going to be hurt. I think there is some evidence that firm franchises have been hurt, and when Shiva points to the payment by PwC, when firms pay big amounts of money to keep things private, it is because they are worried about the franchise. This is the guild, this is the expertise they have built to practice the global practice on. It's not enough. I'm not saying it's enough, but it's part of it.
Yeah, you know, and I think the whole ETF idea hasn't been looked at carefully. I think that they are the villains in the piece, if you ask me.
That's a very good idea.
You know, and that's worth looking into for sure. So I just want to highlight a couple of things that Samantha Ross has been sending on the PCAOB's OEA program, where the fellows can get data. Samantha, that's a fabulous initiative. The worry is that nobody else gets to look at that data. You know, so I wonder, why does it have to be, can you make this open to a broader set of investigators perhaps? Because, you know, science progresses only when more eyes look at it. We don't have enough shorting of Chinese stocks. You need dissent, we need constructive dissent, and we need large teams, like in the medical world, looking at these data sets. So if at all possible, making that open to more people would be fabulous. There are tons of questions, and again, I'm going to blame Scott. We don't have enough time. I have like 5 minutes left.
Questions. How can we get the questions and respond to them going later?
It's on the chat. Yeah, I guess we could do that. We have a grand total of 5 minutes left. And I'm wondering what's the best way to use that time. So a couple of things. We could make our slides available, especially Francine's, I think, are probably more valuable than mine. We could have some way to probably, I'll get in touch with Scott and make sure we do something about these questions, because it's kind of a pity we didn't get to them. So I guess we're back to closing statements. I don't know. Maybe that's the best way to wrap this up. We have 5 full minutes, 2.5 each to Francine first, Jim later, and a plea to Scott to allow 90 minutes the next time.
So I'll just say the last slide in my slides is all my contact information. I am 24/7 girl. You can call, write, text. You have a question, I'm here. For anybody who wants to.
Francine, please be careful about what you promise. I mean, you're going to get millions of questions.
So I go out and speak to students all the time, lots of schools. Some of you may have seen me speak at your undergrad or MAC program. So I want to help you raise awareness, do the research, educate on these issues. So please get in touch, okay? My contact information is there. I've written a lot, or I know who's written a lot about these issues to support your work. And I'm here for you. This is what I do when I go out to schools, talk to researchers at all levels about their research and try to help them, especially if they're interested in it, getting more coverage by media at the right point in the process. So call or write, I mean that. I would love to hear about your work.
Jim, sorry.
When I was in practice and worried about the expectation gap, I heard people say that the accountant was king. This was right after the adoption of Sarbanes-Oxley. Somehow the auditor was now king of the mountain, and management was put in a disadvantaged position. We have now come to the point, I think, in which we can say the economist is king, the academic researcher is king. If we pass through an era of lawyers after the New Deal and accountants after Sarbanes-Oxley, we are entering a period in which people like yourself and Francine and your students and colleagues at the University of Texas and elsewhere are asking the questions that are going to clarify for lawyers, for legislators, and for regulators what they have to do to solve some of these problems. Once the answers are there, I think the pressure to solve them, including pressure on the auditors, will be very strong. Your ETF point being a good one.
You know, Jim, you're so optimistic. Thank you. It's incredible. I mean, I wish that were true, but hopefully it is, because my worry with a lot of academic research, and this is my closing plea to all of you, whatever you do, try to address a question that somebody like either Francine or Jim cares about. Do not go after questions that nobody cares about. You can make your career only by joining a bigger debate. Academic publications are not about scorekeeping to get tenure, although some of you sadly probably will, succumb to that model. The temptation is high. Please do not do it, because it's an amazing job. I love my job. I go to work because I want to, not because I have to. Society gives us free license. Through student subsidized, you get loans. If you're a state university, you're using taxpayer money. If you're a private school, basically getting subsidized federal student debt to keep us going. So we want to give something back. There has to be some social ROI for all the tuition money that people spend, and that social ROI could be high impact, good quality, policy relevant, and practice relevant research. So I'm going to stop at that point, and Samantha, I guess as usual, has the last word. So she says, we'll make it true. Wow, fabulous. Thank you so much. And I'm sorry that we didn't give you a voice and we made you switch your videos off, but I hope you learned something. I learned a lot. These are phenomenal people. I'm glad they gave us an hour of their time. Hopefully this will inspire you to do interesting work, give you some concrete leads. And to the limited extent possible, you could engage with Francine, certainly with me. Jim's a busy man, so I'll leave it at that. So thank you so much. It's been amazing. And I'm sorry I didn't get to your questions. I'm really sorry. We just didn't have enough time. The panel was more lively than I thought. But hopefully you learned something. You know, I promised to stick to time at 6:15. I think we should call it curtains. And I hope to interact more with many of you, certainly with Francine and Jim at some later point in time. Thank you. Thank you, folks.
Bye, Francine. Bye, Jim.